Gold recently hit $3,500 per troy ounce for the first time. Can it hit $4,000? Can it go beyond? Nitesh Shah, Wisdom Tree's resident commodity expert and gold aficionado, believes that under some circumstances, it certainly can. But the story doesn't end there. We also highlight the biggest dislocation in markets since the start of the COVID pandemic, one that happens to be in commodities. Stay tuned to find out. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this podcast is for you. I'm Mobeen Tahir, Director Macroeconomics and Thematic Research at Wisdom Tree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at Wisdom Tree.
So Nitesh, we know we've been talking a lot about gold lately, and of course a lot of people have been talking about gold a lot, but I was thinking back to my first day when I joined Wisdom Tree, 3rd of December 2018. And I remember even back then we were talking about gold. And I just looked up the price of gold on that day, $1,230 per troy ounce. And even though we've come more than 3 times the price of gold over that time, the importance of gold hasn't changed. We were talking about gold then, we are still talking about gold now, even though the price has changed significantly. Just set the scene before we go into your model and what's happening to gold recently. Just set the scene for us. Why has gold been such an important asset class through this period, and is that importance even going up?
Yeah, I would say that gold is a unique asset class. There's very few assets that behave like gold, and therefore gold is one of the best diversifiers to any portfolio. Now, let's go through some of the things that make gold so different and unique. It's neither a cyclical or a defensive asset. It's both, right? It's both simultaneously. It's highly defensive in the sense that it does really well during times of economic and financial and geopolitical stress. Similar to bond markets, right? Bonds tend to do well when the economy is faltering, when there's stress in the financial sector. And that's what gold does. But also, gold tends to perform really well in times of high inflation. And, you know, usually when you've got an economy performing really well, you've got economic strength. As a byproduct of that economic strength, you get inflation. So gold tends to do well even in good economic scenarios. So in the good and the bad economic scenarios, gold tends to do well. Probably does less well when the economy is just middling along, right? It does better at the extremes. Um, so, but there's no other asset class that does that. It performs well at both extremes. Most of the asset classes either perform well in good economic conditions or in bad economic conditions. They tend to have one mode. But because gold does both in two extremes, it really adds to diversification of a portfolio. Now, gold's prominence seems to be rising more and more each day, and especially as we're living in what feels more like a chaotic world. And I guess a lot of that chaos really centers on some of the policy changes that we've seen coming from the US in recent times, and particular with a trade war that seems to be emerging at the moment. And a trade war, as we see it, could be highly inflationary because a contraction in trade or the implementation of higher tariffs increases the prices of goods. That's inflationary. But at the same time, it can also damage economic growth as well, as you get contraction in trade of goods and services or primary goods. You may see lower growth. So the two things that really help gold propel high inflation and potentially slowing economic growth, and on top of that, financial market turbulence, they're all happening in large doses at the moment, and therefore gold's relevance is rapidly increasing.
So, Nitesh, all the things that you've mentioned, of course, there's always something keeping gold relevant. Maybe there are more things keeping gold relevant right now, but recently in April 2025, we've seen gold hitting a new record high, that $3,500 mark, and that came following a few days of very sharp appreciation in gold prices. Of course, gold has been going up steadily over many years, but that sudden surge, what do you think was the catalyst behind that, and can it be sustained?
Yeah, so as I've alluded to, gold's relevance has increased recently, mainly because of concerns around policy, and in particular around trade. So gold has been doing well pretty much since the beginning of this year. It's probably one of the best performing metals of this year, but it really accelerated this month in April. And right at the beginning of this month, April 2nd, we had so-called Liberation Day, where President Trump of the US announced his intentions for implementing tariffs against other countries. And it was both universal tariff and a reciprocal tariff, right? And coming into this, we were all debating whether what form of tariffs would arrive, and they were both. There's a minimum floor of 10% as a universal tariff, and then these so-called reciprocal tariffs, which are tariffs applied to countries that already have some sort of trade restriction, whether it's tariff form or other restrictions. And it took the market by surprise at the scale of these tariffs. Now, I know we've had some sort of reprieve in terms of a lot of the tariffs have been delayed, but that's just a delay, right? And negotiations are taking place at the moment to for countries to reduce the tariffs if they make concessions. But there's very little guarantee at this point in time that these negotiations will be successful. So we may have the shock of higher tariffs to come. Now, yes, I say markets were surprised, but Trump was only delivering exactly what he promised, right? If you look at his campaign platform. This is what he's been talking about for a while. He calls him, he's a self-titled tariff man. He wants to increase tariffs because he believes that the US is getting the raw deal. They're not getting a fair deal in terms of trade with other countries. He believes that the US's trade deficit is due to a bad deal. But regardless of what his thought process is, the market has been shocked, and it does feel to many people that the status quo has been destroyed. But also, it's not just trade wars; it's other policy dimensions as well. So the US has pulled back from military aid to other countries. um, really does indicate that the US is pulling back from its traditional role in global politics and geopolitics. It's insistence on trying to achieve a peace deal in the Ukraine, regardless of how much Ukraine feels like it is keeping to what it originally expected from from in terms of international support. That does indicate that the policy framework has massively shifted, and that's led to a little bit more um, uncertainty in markets. And adding on top of that, in recent weeks, it looked like Trump had been less supportive of an independent Federal Reserve. I know he's walked back in the last week or so about his sort of threat to fire Chairman Powell, but that has nerved markets, and financial markets are highly dependent on an independent central bank and institutional strength in the central bank. So all of these things are driving anxiety and driving the demand for gold significantly higher. And part of what we're seeing within this is the dollar depreciate quite rapidly. And when dollar depreciates, gold in dollar terms tends to rise as well. We've seen a lot of bond market volatility, and bonds and gold are traditionally competing anti-fragile defensive type of assets. But with a lot of volatility in the bond market, gold has become more favored as an asset class. Um, especially comparing to U.S. bonds and gold. And so there's multiple drivers of gold at this point in time, and we think a lot of these drivers are here to stay. And especially if we do see continued dollar depreciation or potentially a shunning of some dollar assets, gold is likely to be favored.
So, speaking of multiple drivers of gold, Nitesh, we know that you have a model which brings together those drivers to explain the price of gold. And that model has served you very well for a very long time and continues to serve you well. And of course, all the users of that model. Why don't you just remind us what those variables are and what that model does? And then we can dive into some of your latest scenarios that you've laid out from it.
Yeah, absolutely. So the model is an econometric model using multiple drivers of gold within it. And the whole idea when I put this together about 10 years ago was to really identify the true drivers of gold prices. I know at any point in time, people are talking about a thousand things that potentially could be moving gold prices. And very often people look at them in a univariate fashion saying, oh, this thing's going up. Like, we got New Year celebrations in X country that's going to drive up gold prices, or there's been a great harvest in this country that means no more disposable cash and therefore gold prices go up. You know, looking at these kind of univariate things can be a little bit misleading. So putting everything together in one place can condition for what is the most important driver of gold prices, and you can almost rank things in terms of the things that don't really matter for gold prices if they don't have a huge amount of statistical significance. Um, and in putting this model together, I found there are four major drivers of gold price, and they include inflation, bond yields. And bond yields are important because, as I mentioned, bonds and gold are competing anti-fragile assets, and you'd expect the price of bonds and the price of gold to go up simultaneously, and therefore bonds, bond yields, and gold to have an inverse relationship. Um, we also have the dollar exchange rate as part of the explanatory variables. And we also have some sort of measurement of investor sentiment towards gold. And it's not there's no perfect measurement of that, but what we do is use speculative positioning in gold futures for that. Now, with those four drivers of gold prices, we can explain about 65% of the movement of gold prices. Um, and you'll note that what's missing from that model is a lot of the physical things. So jewelry demand or ETF demand or ETP demand for gold doesn't exist in a model. We've tested those things and they're not relevant once you condition for these four things. Um, Also, mine supply of gold doesn't really come out relevant, or scrap supply, indicating that gold doesn't really resemble a traditional commodity, right? For most commodities, you'd expect the physical supply and demand of metal to be primary drivers of price. Whereas with gold, they're not even really coming out as statistically significant. And that does indicate that gold is much more like a currency or a pseudo currency than a traditional commodity.
Nitesh, another variable that's notably missing and that's been very relevant and topical is what central banks are doing. And you mentioned the physical side of gold, indeed. And one of the biggest consumers or buyers of gold, if you like, has been central banks. And this really came to the fore in 2022 when central banks started buying large quantities of gold. It held up in 2023 and held up again in 2024. Now, the question is, how much of a challenge that does that pose to your model? Will it become a relevant variable going forward? Uh, and two, can central bank demand going to remain high do they at some point realize, okay, we bought enough and now we don't need to keep buying more, or certainly don't need to keep buying more at the same rate as we were in these last few years? How do you see what central banks have been doing with regards to gold purchases?
Yeah, excellent question, and you've hit the heart of the floor of my model, in the sense that central banks are an important driver of gold prices, and they are a physical buyer of gold, and so that, there is one physical source that should be relevant for price formation, at least statistically relevant. And I'm not saying that jewelry demand and all these things aren't important; they just haven't come up as statistically important. But central banks. The problem with central banks is that the data for their buying isn't great. So central banks report on a monthly basis to the IMF, International Financial Statistics, IFS, um, some of their purchases, but they're really underreport. My guess is they're reporting about a quarter of what they're actually buying in that data. Um, there is slightly better data that comes out on a quarterly basis from the World Gold Council and Metal Focus. And if I were to use that quarterly data and recalibrate my model, so my model works on a monthly basis, the quarterly data have less length of data, so I don't have as many economic cycles to test it on. But if I take that quarterly data, shorter length of data, and it comes out less frequently with a bit of a delay, and if I were to make the model including central bank data, I would get that explanation of the variation of gold prices, which is in technical terms called R squared. In the model without central bank data, the R squared is around 65%. So the scale goes from 0 to 100%. In a model where I include central bank data, the R squared goes up to 69%. So it does improve the model a bit. It explains more of the variation in gold prices. And more recently, which is very important, is my model results for where the model indicates gold prices should be, where actual gold prices should be. There's been a bit of a widening gap. So the actual gold price has been a lot higher than what my model has pointed towards recently. But by including central bank data in that, it closes the gap up a bit. So it does say that central bank buying at these elevated rates that you mentioned has explained a lot of why gold prices have been a lot stronger than what my regular model indicates. Now, the reason I choose not to use the model with central banks in is because it's not looking across many economic cycles, and the data availability is a bit tougher as well. But if we were to correct a little bit for central banks, I think what we're seeing in terms of these really strengthened gold prices is probably about fair, actually. So um, on top of the additional chaos and anxiety we're seeing in the markets, central bank demand at these elevated rates does indicate that gold prices should be about where they are right now. Gold prices slip back to just under 3,300 right now, um, and central banks are buying gold in huge volumes consistently since 2022. As you mentioned, buying has been almost double the rate it had been in the pre 2022 decade. Um, and some of these central banks, like the PBOC, this China's central bank, it took a break for like 6 months in the middle of 2022 until 2024, sorry, thinking that it itself was pushing up gold prices too much, and took a break from buying so to stem gold price increases. But gold prices kept going up anyway. So it's kind of learned its lesson. It's not going to take much breaks from buying because it needs more gold. It wants to diversify its foreign exchange holdings. And at the moment, it has relatively little gold compared to its other FX holdings. So, its gold to other FX ratio is around 6%, which is quite small, compared to other big central banks around the world. And to diversify is going to take, many decades, and many decades buying at the volumes it is buying at the moment. But that's the same story across many other central banks, that they want to have more gold. 2022 was that sort of watershed moment, because that was a point where the G7 countries had almost weaponized their currencies, in the sense that they froze Russia's central bank assets in their currencies. And every central banks are looking for other currencies, and gold seems to be the only shop in town that a currency or a pseudo currency that has this scale, has this liquidity, has that sort of stability, and cannot be manipulated by other central banks that easily. So everyone's trying to get hold of gold simultaneously, and I think that's a story for decades to come.
Very good. So with that, Nitesh, how about we dive right into your scenarios? I know your first one is called consensus, and I like that because having, like you said, the gold being almost like a pseudo currency, it allows you to use consensus forecast for those economic variables and predict the price of gold. But uh, tell us what the consensus scenario is. What are your assumptions, and what do you get?
Yeah, absolutely. So to stress, the word consensus is not a survey on other people's views on gold. Is we take the survey of other people's views on the macro variables, inflation, dollar, bond yields, and we feed that into our model. And what we do there is, one thing we don't get from the surveys is views on speculative positioning in gold, where we take just a conservative view of dialing down the spec positioning to around the long-term average of around 200,000 contracts net long for gold. Now, I should stress that the survey that we used was from the end of March, so that was before so-called Liberation Day, before a lot of the uncertainty and chaos was injected into financial markets from the announcements from Trump around intentions on tariffs. Um, so at the time the survey was taken, markets were expecting a little bit of dollar depreciation, but not as much as we've already seen so far. And the markets were expecting the sort of bond yields um, to be a bit more elevated. And right now, I think the markets are um, starting to price in a little bit more um, assistance from the Federal Reserve in terms of cutting short-term interest rates, which should start to bring down bond yields, 10-year bond yields as well, further down the curve. So in that consensus forecast, where the dollar depreciation was coming from around sort of that 106 level to around 103, and I can say we're already, this is the dollar basket, we're already below 100 at the moment. So a lot of that depreciation has already occurred over that focus horizon, which is going to Q1 2026. Um, so that consensus view would bring gold up to 3,600 per ounce by Q1 2026. So there's still upside from even that high that we hit last week, even in that consensus scenario. But as I said, a lot of the market has shifted in even in that very short span of time that since the last consensus survey was taken, that we utilized from Bloomberg. And we have a bull case scenario, and I do think that the world we're going to live in is closer to the bull case scenario than the consensus scenario, where we have a sharper dollar depreciation. So the dollar basket goes to 97, and we're at 99 right now. So not much that much further it has to go down really to hit that that level. And in that scenario, we do have Fed cutting rates, and that assists the long-term bond yields, so 10-year yields coming down. And so in that forecast for Q1 2026, we have 10-year yields going to 3.62%. So that's not that much of a stretch of the imagination, and not that much further lower than some of the low points we just hit in recent months. And inflation under this world of higher tariffs, not just in the US, but elsewhere. But the model is focused on US inflation rates that goes to around 5%, which is I think perfectly reasonable in a world where you have such elevated tariffs, and that could drive gold prices to, drum roll, over 4,000. So $4,210. So in a scenario, as you were putting out in the intro, under a fairly realistic scenario, you could get gold prices heading over 4,200. Now, there's a couple of other scenarios we put in this publication as well. Let me go into the bear case scenario. Now, in a bear case scenario, what we're talking about is inflation being capped at 2%. Now, I think it's very unrealistic that we get inflation at 2%. Not even the Federal Reserve believes in a 2% inflation world, and that's their job to achieve inflation around 2%. So if you look at their dot plots, there's very little views from any of the decision makers there that we could get to around 2%. In that bear case scenario, we're going to have a sharp dollar appreciation to the dollar basket going to around 113. And we have bond yields at very elevated rates at around 6.5%. So very unrealistic. And in that circumstance, you'll get to Q1 2026 prices of 2,700. And, that only traces back gold prices to where we were in the middle of last year. So the downside's quite capped, but even in a quite stressed scenario, which I don't think is very likely in this bear case scenario. Now, there's one more scenario that we put into these outlooks for the first time, and we call this a Mar-a-Lago Accord scenario. And now let me explain what that is. Now, in recent times, the markets, a lot of commentators in the markets have been talking about an intentional dollar depreciation policy. Now, let me stress that no one from the US administration has been explicitly talking about a dollar depreciation explicit policy scenario. And although at times policymakers, including President Trump, has grumbled about a strong dollar, and has also grumbled about other currency manipulators, nobody's really talked about an explicit policy like this. Now, Mar-a-Lago is named almost after the Plaza Accord of the 1980s, and in the Plaza Accord in the 1980s, that was a period in which the US convinced a lot of its trading partners to help it depreciate the currency, and in that period of depreciation, you got something close to a 40% depreciation of the currency. Now, in this hypothetical Mar-a-Lago Accord, where the US tries to depreciate its currency, we see a lack of opportunity to convince other countries to actually actively participate in helping US achieve that depreciation. So in this scenario that a lot of people are talking about in the markets, it possibly could be done through force, and some of that force may come via refinancing a lot of the US bonds. refinancing some of the bonds which are coupon paying to either zero coupon or very low coupon paying, um, could drive that dollar depreciation. Um, and as a result, what we're modeling in this scenario for gold is around a 20% depreciation on dollar. We believe that inflation would be very high with trade wars in the background, but also this policy move of a lower dollar could drive up inflation domestically as well. We don't really put an explicit bond view in because bond yields could just go from anywhere, right? The intention is to bring down refinancing, or debt costs from this policy move, but the manner in which it's done may just drive bond yields significantly up. So bond yields could go in any direction. So we are kind of almost exclude bond yields from the equation here. Um, and what we do is put spec positioning for gold significantly higher because gold becomes suddenly more important in a world in which the rules are just being constantly rewritten, and people flight towards gold as that sort of haven asset. So there's that flight to safety there. And in that scenario, we put in a gold price of just over $5,000 per ounce, and I think that could be potentially conservative if this policy were to be taken up. Now, I don't think that there is such a policy even being discussed in seriousness, but by the current administration. But in this world we're living in right now, where I guess less things can be ruled out than I thought 6 months ago. A lot could happen. So we thought it's good to model this out because people are discussing it in markets at the moment. So, four different scenarios out there, and I do think the bull case is probably more of the realistic scenario of the bunch.
So, Nitesh, we speak a lot to investors in exchange traded products. And I remember when gold was at 2000 and we were talking to investors, and forecasts of gold hitting 3000 uh, were being introduced. A lot of people were thinking, really, $3,000? How can that be? And now, of course, you've laid out scenarios where it can hit 4,000 and beyond. But it's interesting, even despite gold making these gains and crossing those levels, which seemed unbelievable to investors not too long ago, buyers of exchange traded products are perhaps buying more. I'm just curious to get your take. I know, just share your observation on what buyers of exchange traded products are doing in general, and just how you've experienced people reacting to your latest forecast where you've laid out a scenario where gold can exceed 4,000 as well.
Yeah, absolutely. So yeah, you're right. There was a lot of skepticism about gold rising so much not so long ago. Between middle of 2022 and middle of 2024, um, globally we were seeing outflows from gold exchange traded products, despite the fact that gold prices were rallying during that time, and many other pockets of buyers were still heavily buying. So the over-the-counter market was still pretty strong during that time, whereas the ETP exchange traded product market was quite was seeing outflows. Then in the middle of 2024, we started to see those outflows stem, and we started seeing a gentle rise in inflows. But it was a very gentle, modest rise. But start of this year, we're starting to see a bit more of a more aggressive buying from exchange traded product buyers. I think they're a lot more convinced that we've got a longer enduring rally in gold. Also, in contrast to the middle of 2022 or whatever, when gold was competing against really, really cheap bonds. We don't really have that anymore. And indeed, we have a lot more bond market volatility, which people are trying to get away from. So gold is the answer. So we are seeing a lot more inflows into gold in general this year. okay, the last few weeks maybe in a little bit of a pullback, a little bit of profit taking, for one, with these high prices, but also we've also seen a little bit of stressed selling, because some uh, institutional investors, when they have margin positions on um, other volatile assets like equities or bonds, and they get margin calls, they need to draw on liquidity, and gold is like a cash like liquid product, and they've drawn some of that liquidity to meet their margin calls elsewhere. But in all likelihood, they like to come back into this product when that volatility in these other asset classes surges. So, um, I think we are going to see a little bit more interest from the exchange traded product market for the duration of this year. And
Very
so your
interesting.
next question was on reaction to my forecast.
Of course.
So yeah, I mean, I think a lot of people, once again, are repeating, oh, you know, how can gold go that much more higher, right? And you just have to point to the recent past. Say, look, I mean, the last 3, 4 years, that disbelief has been met with, increases in prices. And I think, some people take profit at these sort of levels, but are ready to come back in, once you get a price dip. But I think more and more people are waking up to a potential, um, you know, change of, uh, you know structural circumstances, especially in the US. If the US, I know Trump has walked back on his criticism of the Fed, or his threat to fire yeah, Chairman Powell, but it's hard to know when that that discord will come back again and again, and I think people are worried, and therefore are looking for these assets that can be hedges for this. And I certainly do think that a lot of the people who are looking at these high prices with skepticism will probably come back and understand where they're coming from. Yeah, yet to be seen. The future is not written yet, but here's some scenarios I present.
Fantastic. So, Nitesh, gold is certainly glittering, and we've talked a lot about it. But of course, all that glitters is not necessarily just gold. And I mentioned in the intro that there is a dislocation in the commodity markets, and we talk about the gold to silver ratio. Now, the gold to silver ratio is something that peaked back in March 2020, and this was the start of the COVID pandemic when lockdowns first occurred. And at that time, the gold to silver ratio peaked at about 120 odd. And recently, Nitesh, and you make this observation that we've had another peak of that ratio. Tell us why that ratio matters, and what does this recent peak tell us in the context of what happened last time in 2020, and what might happen again in 2025?
Yeah. So, the average gold silver ratio since 1990 has been around 70, right? Um, uh, and in 2020, yes, it went nuts. It went to 120, about 4 standard deviations above average. But right now, we at just over 100. That's still like 2 standard deviations above average. That's quite stressed, I would say. So gold, silver, even though it's been rallying during the course of this year, it hasn't rallied as much as gold. And even last year, when silver was rallying, um, it stepped back a little bit towards the end of the year and widened out that ratio. I think silver's got a lot of catching up to do with gold. And in 2020, once silver started making that catch up, it made a 90% rally, 90%, not 19, 90. So it can be very, very strong. Um, and silver has roughly an 80% correlation with gold prices. But it has a higher beta, a high beta of sort of around 1.4. So as gold prices go up by 1%, you'd expect silver to go up by 1.4%. um, and Silver's demand is pretty strong. So we talked a lot about gold in the context of being a pseudo monetary asset, where physical demand doesn't really matter that much. But silver is a bit different. It is much more like a regular commodity. Physical demand does matter for prices. So that 80% correlation we have with gold, the other 20% is really explained by physical supply and demand factors, and a large part of silver demand is industrial demand. Um, so industrial demand for silver has been strong over the last few years, and it's kind of puzzling, right? Because we've been in an industrial recession for the last few years. Why should industrial demand for silver be so strong? It's the specific uses of silver that matter. And one of the big uses of silver is in photovoltaics, so that's solar panels, but also for as used as a sort of electrical conductor, and with a lot of other facets of electrification happening at the moment. A lot more electronics out there. Um, we got even in cars, for example, in internal combustion engine vehicles, you have a lot more electrical components, and then you have these electric vehicles that have even more electrical components. You're seeing a lot more silver demand. So this year, with trade tariffs and all these uh, factors, we do think that industrial demand in general may be falling, but for silver, we expect the trend of the past few years of silver demand going higher. So to put into some context, with our sort of consensus gold view, the equivalent silver price forecast is for $40 an ounce by Q1 2026. So that's from just roughly $33 an ounce right now. And in that more bullish scenario, which I think is more realistic for gold, the equivalent scenario for silver is around $50 an ounce, which would take silver to its new high. So that would be quite a momentous moment for silver, and I think it's realistically achievable.
So, speaking of industrial characteristics, Nitesh, we track the demand and supply dynamics in industrial metals as well. And I know you mentioned in the context of gold that sometimes demand and supply dynamics don't matter as much, but when it comes to commodities like copper, for example, demand and supply dynamics do matter. And for that, we often turn to what the study groups are telling us. What do you see in terms of the dynamics there? Which ones are interesting? Copper hit a new peak back in March, and then it pulled back very sharply, and now it's going back up again. So almost surprising to see this much volatility in copper, but maybe it's in line with what else is going on in markets. How do you see copper and the rest of the industrial metals basket?
Yeah, there is a lot going on. So, people call copper Dr. Copper because it's supposed to be um, telling you a lot about the state of the economy. It's
Mm.
supposed to be used as almost a forecasting tool of where the economy is. And strong copper prices indicate a healthy economy. Weaker, indicate that the economy is faltering. And obviously, a lot of the trade war fears around demand destruction, and that's what's led to some of the pullbacks in copper prices when we've had them. But simultaneously, there's all the worries about whether there'll be enough supply of copper going to the right places. And obviously, if you have countries like the US, which is a large copper consumer, and you have tariffs being implemented, will the US be able to get hold of enough copper? Now, right now, to stress, there aren't universal tariffs on copper at the moment, but there is a Section 232 investigation onto the strategic importance of copper, and as a result of that, you may end up getting tariffs applied onto copper fairly soon if the indications from the administration correct, they want to sort of accelerate this study and get them implemented. Um, so copper, plays a huge role in industrial activity and is giving a lot of indications of where demand is at the moment. But I would stress that despite all these demand destruction fears, copper demand at the moment seems to be really resilient, and we're seeing those sort of trends coming from China, um, where if you look at the Shanghai Futures Exchange, the inventory of copper has been coming down. And there are reports of scrap supplies being generally lower, which is helping to draw down on these um, you know finished refined copper reserves. And China seems to be a story of trying to accelerate electrification. And to accelerate electrification, you need a lot more distribution and transmission cabling, which is very copper intensive. Now, in this context of a trade war, where global demand may be weakened, economic demand may be weakened, China may stimulate its domestic economy, and in doing so may double down on the strategies being already employing for the last couple of years, which is to accelerate electrification and energy transition even more. So if it doubles down on this existing strategy, it could see copper demand rising even more over the next few years. So demand remains quite resilient. And somewhat evidence of this is that the International Copper Study Group last week, when they had their semi-annual meetings, they look back at the 2024 supply-demand balances. And if you remember to September 2024, they were pointing to massive surpluses for 2024, over 400,000 tons of surplus of copper. And that is at the tail end of last year. But looking back, so now that they've got the confirmed numbers here, sitting in April, they revised that down significantly. They chopped down the surplus by by more than half. So way under 200,000 contracts. So 200,000 tons of surplus. So the demand was a lot stronger than what they were thinking about earlier, and the supply had been a lot more restricted. And even though they got a supply forecast for 2025, I'm taking that with a bit of a pinch of salt. I do think that uh, the the surpluses will be coming in much more narrower as demand remains quite resilient, and I think there could be a lot more disruptions to the supply going forward. So I think copper is in a fairly healthy place, and even if my best guess is that China does double down on this energy transition, which will be not only helpful for copper but also silver as well, that we discussed about earlier.
Fantastic. So, Nitesh, in the spirit of hitting all the sectors, how about we get your thoughts quickly on oil to conclude? And of course, we've seen perhaps a more bearish picture for oil lately, but for many years, or certainly a few years recently, we've seen oil trading in that maybe the $70 to $90 range, and that kept investors certainly who are tactically inclined, and a lot of people trade oil quite tactically given its cyclicality, compared to say an asset class like gold, of course, which is perhaps more strategic for more investors. uh, Maybe that range has changed, but that still keeps those investors interested, because there will still be flows and there will still be points in which they would want to buy and points at which they would want to sell. So, what's your take on what that new floor might be, and what might keep investors engaged on the oil topic?
Yeah. Well, let's firstly address why we may have moved to a lower range, and that's once again driven by the trade war and demand destruction fears. But simultaneously, the Organization of Petroleum Exporting Countries, which control around 45% of global oil supply, they have vowed to increase supply, unwinding some of their restraint. Why they've chosen this moment in time once again looks quite bizarre, knowing that there is a weaker demand, and they seem to be repeating mistakes of 2020. Remember, back in 2020, I mean, the COVID crisis, they had sort of internal disputes that drove them to increase production. This time around, they're increasing production more to appease President Trump, I presume, who fears he's got an internal inflation problem generated by some of these policies and wants oil prices to come down. And I think some of the OPEC countries have moved to address that. How much oil prices, how much oil supply will fall is still a bit debatable, because some of the countries that have kind of cheated on their quotas have to actually make up for that, those cheats, and therefore actually have to keep supply a little bit more strained. But the signaling is from OPEC that they're actually increasing supply at a time when demand is falling. So that's why we've seen the corridor of the trading range move lower. Now, earlier, we did actually see Brent oil prices fall below $60 a barrel, which is particularly weak. But we saw it snap above that fairly quickly, indicating that there is that floor around $60 a barrel. I'd be surprised if oil prices go back towards sort of $80 a barrel, where we were at right at the beginning of this year, given the demand weakness, unless OPEC change their strategy once again. But I think we will trade within this range, so long as OPEC, even if they're saying increasing supply, that they are likely to keep their policies in place that they will restrict significant oversupply. So if they produce at maximum capacity, then yes, the floor is taken away. But if they say they're at least managing some of the production, that keep the floor in place, and most importantly, it will keep the oil curves in a state of backwardation, which is very important for investors in oil futures or exchange traded products that track oil futures, because the shape of the futures curve matters for the overall investment. And curves in backwardation, so when curves downward sloping, actually enhance returns, because as the futures price approaches the spot, in a backwardated market, is usually rising. So that's a very important factor. Now, in this period where we've seen a bit of oil price weakness, what we have observed is that some countries use it opportunistically, and China is a prime example. We saw that back in 2020 as well, when oil prices collapsed. China has built out lots of storage and bought up a lot of oil. Right now, we are also observing China is buying more and more oil. It's increasing its purchases. You can see tankers going into China are rising, probably to get ahead of these tariffs as well that may come into place. So it's buying at sort of lower prices while before tariffs are implemented, that may hamper or may increase some of the pricing. But China is definitely taking advantage of some of these cheaper prices, helping to strengthen that floor at around 60.
Excellent. Well, with that, we thank everyone for tuning in. We hope everyone enjoyed this episode of the Commodity Exchange. Before we close, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as forecast research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. If you want to hear more from us, please subscribe on whichever platform you're using, and please do take a moment to leave us a 5-star rating. You can follow us on LinkedIn or X. Both me and Nitesh are on those platforms, or you can follow Wisdom Tree on those platforms as well. And if you want to learn more about commodities, visit Wisdom Tree's website where we have a wide range of research materials and insights. With that, see you all next time.